Are you looking for a way to invest your long-term money in a way that's both low cost and also effective? In this video, we'll discuss the differences between index funds and mutual funds, and I'll explain why index funds are a better choice for most investors. We'll also cover some of the key benefits of index funds, such as low cost, diversification, and their long-term track record. First of all, what are index funds and mutual funds? Index funds are a type of investment fund that tracks the performance of a specific market index, such as the S&P 500. You've no doubt heard of several indexes already. The S&P 500, for example, is an index of 500 of the largest companies in the United States. The Dow Jones Industrial Average is an index of 30. In addition to these indexes that we hear about on the news every day, there are dozens of other indexes that track different groups of securities: large cap stocks, small cap stocks, U.S. stocks, international stocks, even different kinds of bonds, government bonds, corporate bonds, etc. There are indexes for all of these different kinds of investments. So an index fund will own a basket of stocks or bonds that mirror the performance of the index that it's tracking. Mutual funds, on the other hand, don't own the entire index. They're going to own a subset of the stocks or bonds within the index that they're trying to pick that they think will outperform the other ones. Their goal is to outperform the index, and it's all run by a mutual fund manager or a team of mutual fund managers who are highly paid, who are trying to outperform the index. To me, index funds are a no-brainer. They're lower cost, they're lower risk, and they have a proven track record of outperforming actively managed mutual funds over time. Mutual funds, on the other hand, are riskier because they're not as diversified, and they're much more expensive. The average expense ratio for an index fund is about 0.1% per year, while the average expense ratio for a mutual fund is about 1% per year. You're paying high fees to a bunch of fund managers who historically have underperformed the indices they're trying to outperform. Here's a little story that illustrates my point. A few years ago, Warren Buffett bet a fund manager that he couldn't beat the S&P 500 over a 10-year period. The fund manager took the bet, and he lost. By the end of the 10 years, the S&P 500 had returned 10% per year, while the fund manager's fund only returned 7% per year. The moral of the story is simple. If you want to invest for the long term, index funds are the way to go. They're the safest, cheapest, and most likely way to grow your wealth. So which is right for you, index funds or mutual funds? It depends a lot on your individual goals and your risk tolerance. If you're looking for a lower cost, lower risk investment, then index funds are a great option. However, if you're looking for an investment that has the potential to outperform the markets, then you may want to consider mutual funds. If you're the kind of person who likes help selecting and managing a portfolio over time, that's the service we provide to our clients. Please click the link in the description if you'd like to set a time to consult with us. For more on investing and retirement planning, watch these videos next.